Determining the right portfolio allocation is crucial for achieving your financial goals. Gold can play a role in a diversified portfolio, but how much should you own? This analysis explores various portfolio allocation strategies for gold in January 2026, considering factors like risk tolerance, investment horizon, and current market conditions. Let's dive in and explore how to determine the appropriate gold allocation for your portfolio in 2026. Conservative investors typically prefer lower allocations to gold, as it can be volatile and doesn't provide income. A typical range might be 5 to 10% of their portfolio. They may focus on physical gold for its security. Moderate investors can allocate a slightly higher percentage to gold, such as 10 to 15%. They may use a combination of physical gold and ETFs. Aggressive investors may allocate up to 20% or more to gold, especially if they have a strong conviction in its potential. They might use a mix of physical gold, ETFs, and gold mining stocks. Long-term investors, 10+ years, can afford to be more strategic with their gold allocation, viewing it as a long-term hedge against inflation and a diversifier. Short-term investors, less than 5 years, need to be more cautious with their gold allocation, as short-term price swings can significantly impact their returns. Current market conditions, January 2026. Inflation. If inflation is high and expected to persist, a higher gold allocation might be warranted. If inflation is under control, a lower allocation might be appropriate. Interest rates. Rising interest rates tend to put downward pressure on gold, suggesting a more conservative allocation. Falling rates can be a positive catalyst for gold. Geopolitical risks. Elevated geopolitical tensions typically support gold prices, potentially justifying a slightly higher allocation. Economic growth. Strong economic growth might diminish the appeal of gold as a safe haven, leading to a lower allocation. Slowing growth or a recession might increase demand for gold. Stock market valuation. If the stock market is considered overvalued, investors might increase their allocation to gold as a hedge against a potential market correction. Other assets in your portfolio. Gold's role is to provide diversification. If your portfolio is already heavily diversified with other uncorrelated assets, you may need a smaller gold allocation. If your portfolio is heavily concentrated in stocks, a larger gold allocation can provide valuable downside protection. Common gold allocation strategies, January 2026. The Permanent Portfolio, Harry Brown, allocates 25% each to stocks, long-term bonds, cash, and gold. This strategy is designed to provide stability and downside protection in all market conditions. The All-Weather Portfolio, Ray Dalio, focuses on asset allocation based on economic environments, inflation, deflation, economic growth, economic contraction. Gold plays a significant role in hedging against inflation and unexpected economic shocks. The specific allocation varies depending on the investor's interpretation of current conditions. Strategic allocation involves setting a fixed percentage allocation to gold based on long-term goals and risk tolerance, and rebalancing the portfolio periodically to maintain the target allocation. For example, an investor might decide to allocate 10% of their portfolio to gold and rebalance quarterly. Tactical allocation involves adjusting the gold allocation based on short-term market conditions and investment opportunities. For example, an investor might increase their gold allocation during times of economic uncertainty, or decrease it when the stock market is performing strongly. Where does smart money sit? Pension funds often have small strategic allocations to gold, typically 2 to 5%, for long-term diversification. In January 2026, they are likely maintaining these allocations, viewing gold as a hedge against long-term inflation and currency debasement. Sovereign wealth funds can have larger gold allocations, up to 10 to 15%, for reserve diversification and geopolitical hedging. Some may be increasing their gold holdings in 2026, amid concerns about global economic stability. Hedge funds take a more tactical approach, adjusting their gold allocations based on their views of the short-term outlook for inflation, interest rates, and geopolitical risks. High net worth individuals employ a variety of strategies depending on their individual circumstances. Some may have significant allocations to physical gold as a generational asset, while others use ETFs for tactical trading. Given the current economic environment describe the economic situation in January 2026, including inflation levels, interest rates, economic growth, and geopolitical risks. A moderate allocation to gold, 10 to 15%, may be prudent for many investors. However, it's crucial to tailor your allocation to your specific circumstances and consult with a financial advisor. Common mistakes to avoid: over-allocating to gold based on emotion. Avoid making investment decisions based on fear or greed. Not rebalancing your portfolio. Rebalancing is essential to maintain your target gold allocation. Ignoring storage costs and insurance for physical gold. Not understanding the expense ratios of gold ETFs. Stay informed and profitable. Subscribe to our YouTube channel. We provide practical tips and insights to help you make informed investment decisions. Disclaimer: this analysis is for informational purposes only and does not constitute financial advice. Remember to consult with a financial professional before making any investment decisions.